Hi, my name is Paul, and welcome to episode 16 of my monthly stock portfolio series, where I invest $100 every month into Canadian securities. Last month, I went through Morguard and MTY's quarterly earnings, and this month I completely screwed up by mismarking the market holiday on my calendar. So instead of buying my shares on Friday, April 7th, I ended up doing my transactions on Monday, the 10th. All in all, this doesn't change anything for the portfolio. But I do want to apologize for not publishing the monthly video on schedule, which usually comes out on the Sunday that immediately follows the first Friday of every month. So I'm sorry for the inconvenience, and I'll be doing my best going forward to make sure that such silly mistakes don't happen again. Noting that, there are bound to be circumstances in the future where I have to delay things a little bit. So I think that this is a good opportunity to prove that I'm capable of rectifying and adapting to production issues in a swift manner. And you can rest assured that from now on, I'll be double and triple checking the dates of market holidays. Anyway, in this month's video, I'll be summarizing the important things that came out of Knight Therapeutics' fourth quarter earnings results, and as always, I'll be showing you exactly where I'm going to be investing this month's $100. But before jumping right into things, I do have a document that covers the goals and rules that I've set out for investing in the monthly portfolio. So if you're interested, you can access that in the description box of this video. Or you could just watch the first episode of the series where I go over everything in detail, and a link to the monthly series playlist starting in episode 1 is also in the description. Alright, let's get into Knight Therapeutics earnings, which for some reason was a bit late getting added to Cedar, but luckily the full official report was released before I made the video, so all of my information should be accurate. Opening up the report, we can see that the quarterly revenues increased in all three operating segments. And while some of these numbers did see inorganic positive impacts from deals and accounting changes, there was still some organic growth in all segments, with Knight's key products seeing increases in sales. Now, this fourth quarter revenue growth did translate into some minor operating cash flow growth for what is typically the company's worst quarter. So things appear to be going well enough on that end. Plus, the company has continued to reinvest its excess cash into its share buyback program. And if we count the subsequent repurchases, the total common shares outstanding will have been reduced from 112.2 million down to about 108.8 million. Counting up the stock options, warrants, and other specialized units, the diluted shares outstanding would be a bit closer to 114.2 million. However, Ticker, the site that I usually use for making slides, shows the pre-updated share count at nearly 117 million. So, while the buybacks were offset substantially by the year-end employee options packages, this discrepancy in share count should be noticeably lower next quarter. Moving on to the net income, this metric is always impacted by fair value changes on held securities, which in this quarter was actually positive. But there was also an asset write-down due to hyperinflation in Argentina, alongside the usual amortization of intangible assets, which did create an unrealized net loss for Knight in Q4. Lastly, the management provided guidance for 2023 in the press release and on the conference call, where it was stated that revenues are expected to be relatively flat for the year. So somewhere between 280 and 300 million is expected. Now, this lower than expected growth was explained as having to do with new entrants that will be competing in the branded generic space, which is expected to push product pricing and margins lower. And there's no sugarcoating this. It's bad news. But the management did note on the conference call that these waves of competition are normal and expected, and that in order to maintain Knight's market share, the company is going to be actively improving their products to strengthen their portfolio. To end this quarter summary on the brighter side of things, thankfully operating expenses are not expected to increase, and the management said that they're seeing a lot of potential deals out there, so we could have something newsworthy in the coming months for Knight Therapeutics. All in all, I'd say that this quarter's performance was not terrible, but the 2023 guidance was definitely a sour note, and the amount of share dilution done was far from ideal. And that's about all that came out for Knight Therapeutics this month. So, in other news, the Morguard North American Residential REIT made an acquisition of the 240-unit Xavier building in near Northside Chicago for $81 million before closing costs. And this deal appears to have been funded almost entirely by cash on hand. Now, in the press release, we were not told how much rental revenue is being generated by the property, but I was able to find some units that have been listed online, and it looks like we could conservatively estimate that the average rent per unit would be somewhere above $2,300 per month. If we assume a 95% occupancy rate, then we can expect this building to bring in nearly $6.3 million in rental revenue per year. Then, if we divide that number by the REIT's US NOI margin, we would get a net operating income in the ballpark of $3.4 million per year, which would mean that the building was purchased at a cap rate of about 4.2%. A 4.2% cap rate is relatively in line with the rest of the REIT's current property portfolio anyways, so nothing here is too crazy, but I'm sure we'll learn more in the first quarter conference call, which is scheduled for April 27th, and that's 2 days after the financial results are released. While we're on the topic of financial results, MTY Food Group will also be releasing their first quarter's numbers on April 12th, and they'll be having their conference call on the exact same day. Outside of that, there's no other news to cover this month, so now it's time to check in on the portfolio. Now, March of 2023 was a particularly brutal month for the portfolio, but it started out like any other. I deposited my usual $100 of cash into the Wealthsimple account, and I received $4.27 in distributions from both Morguard and MTY during the previous month. So I took that $104.27 and I invested all of it, acquiring 4 shares of the Morguard North American Residential REIT, 3 shares of Knight Therapeutics, and 0.216 shares of MTY Food Group. Unfortunately, the best performing holding this month was Morguard, whose shares declined by a massive 9.65%. And yeah, you heard that right, this was the portfolio's top performer this month. And MRG's unit price dropped from $18.55 to $16.76. The next best performer was Knight Therapeutics, who, on the back of lowered guidance, saw its shares decline by 10.62%. This means that its share price plunged from $5.18 down to $4.63, with the trough of this decline marking the lowest share price in the stock's history. Lastly, the worst performer was MTY Food Group, whose shares crashed 12.02%, going from $67.29 down to $59.20 as of the market's close on Thursday, April 6th, 2023. Naturally, each of the holdings having poor monthly performances pushed this month's return deep into negative territory, with the unrealized loss on March's investment capital hitting negative 10.12%. This means that the $104.27 that was invested this month was reduced down to $93.72. But that is before accounting for the dividends. Thankfully, Morguard's monthly payout did lighten the blow a little bit, pushing the end total up to $97.32. Unfortunately, that's still an unrealized loss of 6.67% in just 1 month. Now, if we take a look at the entire portfolio's results since inception, the current market value is sitting at $1,473.02, which is a loss of 3.38%, or about $51.50 on the $1,525 or so of capital invested. So, things took a dramatic turn for the worse this month, but we sought to compare the portfolio's performance to the benchmarks. And if we don't include the dividends that were earned, my portfolio was easily the worst performer of the group. But if we count the dividends, my portfolio was able to surpass the worst performer, the Global Value ETF, which had a somewhat similarly large decline of 8.1%. Next, the 2 Canadian stock ETFs each experienced losses of about 2%, which means that this month's first place ETF was the S&P 500, which had a gain of about 6%, thanks to it being the only one of the group to receive a dividend during the period. But even if it didn't receive a dividend, it still would have had a gain of about 0.8%, which would have been enough to put it in the lead anyways. So not much solace to be had there, and taking a look at the total comparative performances net of contributions, we can see that the mighty have truly fallen. My portfolio has gone from being nearly in first place and way above my annual goal to now behind the rest of the pack and slightly below the break-even point. Meanwhile, the Global Value ETF has similarly crumbled, giving up its long-held first-place position to the S&P 500. But all is not lost. This is far from the worst position that my portfolio has been in, and if you look at the highlighted cells here, you can see that my portfolio has already recovered from a much worse position in the past in only a matter of months. So it's important to realize that volatility is expected to happen, And when it does happen, whether it be for better or worse, it's equally important to keep a cool head and analyze things rationally. Personally, I've been mulling things over for the past few weeks, and as I'm sure you could tell from the title and thumbnail of the video, I've decided to make some pretty big changes to the portfolio. To start, I'm going to be selling 50% of my stake in Knight Therapeutics this month, and this is for 3 reasons. First, it's become clear to me that their branded generics business is not as competitively advantaged as I'd originally concluded. Furthermore, I don't really know what the process of making their drugs to be more competitive actually involves. Now, I could imagine that this might involve increasing research and development costs, or maybe Knight will just work on improving supply chains or production. But I honestly don't know what Knight's strategy is going forwards, nor do I know how effective this strategy is going to be, and I don't know how strong the new competition is. Now, to be fair, I was aware of my limited pharmacological knowledge when initially investing, but I was hoping that my understanding of the capital allocation strategy and the management's history would allow me to skirt by without having to know as much as an expert in the field. Needless to say, I stepped out of my circle of competence and was deservedly whacked. My second reason for selling the stock is that with these new competitors expected to lower margins, I have concerns about the repurchase plan going forwards, as Knight currently is at its lowest cash position with an almost equal amount of long-term debt. This means that on top of there being less profit, there will also likely be higher interest expenses, which will either require cutting back on the repurchases, more debt, or higher free cash flows. Unfortunately, the latter seems very unlikely given the current circumstances, and the former 2 options are negative deviations from my original investment hypothesis. The third and probably most important reason, however, is that after several months of searching through different investment possibilities, a better opportunity that is incredibly easy and obvious to me just sort of fell into my lap on March 29th. This was the date that I learned that one of my largest personal holdings had dropped nearly 15% overnight. But as I read through the company's press announcement, it turned out that this discount was actually better than I'd imagined, because the supposed bad news that caused the stock to drop actually gave clarity to one of my main risk factors for the company. And this realization of the risk turned out not to be as bad as I'd originally priced in to my valuation. To properly explain what I mean by this, I'm going to have to first introduce the company that I'm talking about. So, without further ado, the company is goeasy. And goeasy trades under the ticker symbol GSY on the Toronto Stock Exchange. Now, I won't go too into detail on the company in this monthly video, but I will make a video in the future to further outline my investment hypothesis in depth. Though I do already have a video that covers a fair amount back when the company was trading about 45% higher than it currently is. To give a brief summary of the company's operations, goeasy is a lending company that offers different types of loans and ancillary products to non-prime lenders through its Easy Financial and Easy Home segments. So, goeasy allows people who have bad credit scores to access things like auto, home, business, and personal loans from the Easy Financial segment, which operates out of retail branches, their own online platform, and through partnerships with digital and in-person merchants at the point of sale. The Easy Financial segment also collects commissions on optional insurance and benefits programs that pair with the company's lending services. Meanwhile, the smaller Easy Home segment offers lease-to-own furniture, appliances, and electronics through its franchised locations and e-commerce platform. goeasy's goal as a business is to secure the niche lending market that exists between the large institutional financial lenders and the predatory payday lenders. To do this, goeasy sets out to offer Canadians with subprime credit the opportunity to borrow money through customizable plans that are flexible and straightforward. This, alongside goeasy's free financial literacy literature, tools, and services, helps the customer to rebuild their credit and gradually progress towards lower rates of interest and eventually graduate back into being a prime borrower. Now, this all sounds great, but it's more than just talk. According to a TransUnion study, 60% of Easy Financial customers improve their credit scores within the first year of borrowing. And within that same first year of borrowing, 1 in 3 customers graduate back into prime borrowing rates. To go further than I did in the video that I mentioned earlier, I am strongly of the belief that goeasy's business practices are more ethical than the standard institutional lenders. That said, I'm going to be saving that topic to cover later in my dedicated goeasy video. As for the news that caused the stock to drop, on March 28, 2023, the Canadian federal government announced that it would be cracking down on predatory lending by lowering the maximum allowed annual percentage interest rate on loans from 47% down to 35%. Regardless of all feelings on the matter, this will definitely have impacts on GoEasy's business, which is why the company released a message to shareholders outlining exactly how the company will be affected and the changes it will have to make going forwards. The key takeaways from the letter were that only about a third of the company's loans are above the new 35% regulation, and the average loan for this above regulation group is about 42.5%. Also noted in the report was that the average APR for GoEasy's customers has dropped from 45% down to 30% since inception. So the company has already been trending towards lower and lower rates, largely in thanks to their customer base who have been consistently improving their credit ratings within the GoEasy system. Plus, these new regulations are prospective in nature, meaning that existing loans at above 35% APR will be allowed to continue until they've been fully repaid. This means that there is literally no risk of customers with the worst credit scores being all of a sudden bumped down into more moderate borrowing rates. So there will not be negative impact on net income due specifically to an uncompensated increase in risk coming from increased charge-offs at lower borrowing rates. Now, as I said before, this reduction to a 35% maximum APR isn't as severe as I had originally priced in, and it does come alongside other regulations that I think will adequately dissuade the more predatory payday lenders. So this change will likely reduce competition in the space and drive more customers towards the easy financial segment of the business. That said, the risk of additional cuts to the maximum allowable APR is still on the table, though it will probably be at least a couple of years before we get any word on how things turn out this time around. Personally, I don't think that this rate cut is inherently good. There are tons of people who make crippling mistakes with debt due to financial illiteracy, dubious lending practices, or, what's more commonly the case, a mixture of both. These people who have fallen through the cracks and are deemed high risk are now much more likely to be denied the opportunity to borrow money that could help them to rectify past circumstances and get their financial lives back on track. So, in effect, if someone has bad credit score, they're now going to be less likely to qualify for, say, an auto loan, which might be necessary for them to reliably get across town to their job, which, in my opinion, is a travesty. That said, I am very open to the idea of being wrong on my current leaning. It could very well end up being the case that this maximum APR change leads to better results for prospective borrowers who have bad credit histories. However, given the information available, I just don't currently believe that to be the most likely outcome. But I'll happily change my opinion if the data goes on to show otherwise. For this reason, the risk of further regulation that would affect GoEasy, in my estimation, is fairly minimal, especially in the short term. Noting that, there is still one big risk that will keep GoEasy from receiving a weighting in my portfolio similar to Morguard's. This risk is that GoEasy may have substantial charge-offs in a recessionary scenario. So, while the company's balance sheet looks strong, the value of their loans are accounted for as assets, and these assets could be subject to a significant write-down, especially if a large portion of their customer base is considerably more likely to be negatively impacted by a recessionary environment, which I highly suspect to be the case. That said, I am fairly confident that the company will be able to make it through most recessionary scenarios, and I'm strongly of the opinion that the company will be a very long-term compounder, especially if they're able to successfully expand their business model into other countries, as the management has planned in the coming years. So this month, I'll be looking to purchase my usual 4 shares of the Morguard North American Residential REIT, a $20 fraction worth of an MTY Food Group share, and the remaining money, including the capital from the 50% sale of my Knight Therapeutics position, will be going into fractional shares of GoEasy. And the reason I'm purchasing so much of GoEasy this month is just because my other holdings heavily outweigh my current GoEasy position, which is nil. And I'm very happy to be purchasing shares at what I'd consider to be a very discounted price. Also, the reason that I won't be selling 100% of my stake in Knight Therapeutics is because I still believe that the company has a good management team that is shareholder-centric. And even though I've been punished, I still hold the belief that the quality of the management will be enough to turn things around over the long run. Assuming, of course, that what the CEO stated on the conference call is correct and that these competitors are not a significant long-term threat. That said, this could be my personal biases speaking, and I may well need another good whack to get all of it out of me. Either way, time will tell, and I will learn. Alright, I'm here inside the account. It's Monday, April 10th, which is a bit strange, and I have $103.60 to invest, but it's going to be a bit more than that, because I'm going to start off by selling 17 shares of Knight Therapeutics. And that should give me about $78, maybe $79. So let's sell that. Okay, now we have $182. So the next thing that I'm going to do is I'm going to buy my 4 shares of the Morguard North American Residential REIT. And that leaves us with $114.38 left to invest. So I'm going to spend 20 of that on a fractional buy of MTY Food Group. And then I'm going to buy all of the rest in Go Easy, and we're going to do fractional buys of that. So we have 94.38, which is almost just 1 share. All right, and I will be back once those buys come through. Okay, I'm back and I've officially sold my 17 shares of Knight Therapeutics for $4.62 each. After the sale, I also purchased 4 shares of Morguard for $16.94 each. Then, in fractional shares, I purchased 0.3281 shares of MTY Food Group at a cost basis of $60.94 per whole share, and I purchased 0.9971 shares of Go Easy at a cost basis of $94.65. And after making my transactions for the month, there was 1 extra cent left over. So a little bit unlucky this month, especially considering that I could have ended up with more than a whole share of Go Easy if I hadn't have gone for the fractional buy order, which ended up clearing at a higher price towards the end of the trading day. But at least now I'll know for next time that when I do a fractional buy, the time that my order was placed doesn't actually have any bearing on the price that I'll end up paying once the order clears. Taking a look at the standings, as of the market's close on Monday, April the 10th, the portfolio currently holds 68 shares of Morguard worth about $1,151, roughly 4.37 shares of MTY Food Group worth a touch over $266, nearly 1 share of Go Easy worth almost $95, and 17 shares of Knight Therapeutics worth a hair above $79. And of course, that 1 last cent was still left over. Transitioning into the dividend tracking segment, only Morguard paid out a distribution this month, and it totaled $3.60. But other than that, there weren't really any dividend milestones of note in March. That said, I did include yearly dividend accumulation tallies, and even though we're only 3 months into 2023, the portfolio has already collected well over half the amount of dividends that were earned during the full year of 2022. So things are really starting to pick up nicely. As for what we can buy with the $3.60 in dividends, well, I found a deal that applies to both bleach and laundry detergent, so now we can clean up just about any mess that might get left behind after we notice that our investments have dropped 10% over the course of a single month. Ouch. Thankfully, at the very least, next month I can look forward to receiving more dividends, since the portfolio is expected to be paid out $3.84 from Morguard. As for the total cumulative dividends earned, since inception, the portfolio has now received $28.10. So next month, we should be hitting the $30 mark, and from there, things should start to really take off with larger dollar amounts of separation between months. Noting that, if I were to just leave the portfolio as it stands and collect the dividends in cash, assuming no changes were made, over the next 12 months, I would expect to receive $57.16, which is a 14% jump up from last month. And the reason for this month's big increase here is because I sold a large amount of my position in Knight Therapeutics, which currently pays no dividend, and I used that money to buy Go Easy stock, which pays a hefty 4% dividend. So, as you could probably expect, this pushed my portfolio's yield on contributed capital to 3.57%, which is quite high, but from what I can see, most of the good deals out there currently pay dividends at the moment, so I'm just taking them as they come. And with that, I think that this episode has gone on long enough. But before you leave, please remember that this video is not financial advice and that I am not a financial advisor. This video was made entirely for the purpose of providing inspiration and insight into my personal investment decisions, and it should not be used as a substitute for doing your own research. This video does not have the information required to make good investment decisions on individual securities. So again, I am not a financial advisor. I'm just a Canadian who likes to invest and share my opinions with others. And in doing so, I hope that I was able to provide you with something of value. And if I did, then please consider sharing with anyone else who may also benefit from it. Thanks for watching all the way to the end, and enjoy the rest of your day.